Hey everyone, welcome back. Real quick before we jump in, this explainer is brought to you by CertFuel. They've got a seriously awesome full Series 66 course with adaptive study quizzes, smart flashcards, and unlimited practice exams weighted exactly like the real thing. I highly recommend checking them out at certfuel.com. Okay, let's get into it.
So, meet Adam the advisor. Poor Adam has a massive headache today, and it's all because of Carl the client. See, Carl has built up this absolute mountain of wealth, right? And he wants to protect it. We're talking shielding it from taxes, keeping it safe from creditors, and honestly, maybe even protecting it from his own terrible spending habits. He wants to know how to structure all this completely legally. So, what's Adam's big solution? Trusts.
Now, you might be wondering, what actually is a trust? If we strip away all that dense, fancy legal jargon, a trust is literally just a legal arrangement where one party holds and manages assets for the benefit of another party. That's it. Think of it as a legally binding three-way relationship that wraps up a pile of money with a very specific set of rules.
Let's look at how these three roles interact. I like to call them the three trust amigos. First up, you have the grantor. Sometimes you'll see this called the settlor or trustor on the exam. That's Carl. He's the guy who actually creates and funds the trust. Second, you have the trustee. That's our guy, Adam. The trustee is the one managing the assets, and he is bound by a strict fiduciary duty. That means he has a legal, absolute obligation to act prudently and solely in the best interests of the third amigo, the beneficiary. In our story, that's Carl's kids, who actually get to receive the income or the principal.
But Carl has some choices to make here. He could set up a revocable trust, which is also known as a living trust. Now, in a revocable trust, Carl keeps the keys. He can modify it, amend it, or even just dissolve the whole thing whenever he feels like it. It's incredibly flexible. But, and this is a huge but, because Carl can pull the ripcord at literally any time, the Internal Revenue Service says those assets remain part of his taxable estate. Oh, and they offer exactly zero protection from his creditors.
On the flip side, Carl could choose an irrevocable trust. You got to think of this one like launching his money into space. Once Carl puts the assets in there, he permanently gives up control. He generally cannot just unilaterally change his mind and bring that money back down to earth. But because he actually gave up the steering wheel, those assets are generally removed from his taxable estate, and they actually might be shielded from his creditors.
So, here is the absolutely crucial point, the ultimate exam trade-off. On the one hand, revocable means you keep full control, but you get zero creditor protection and absolutely no estate tax benefits. On the other hand, irrevocable means you surrender that control, but you potentially gain creditor protection and get to exclude those assets from your estate. The exam tests this trade-off constantly, so definitely lock it in.
And this difference heavily impacts taxes too. Because Carl controls the revocable trust, the IRS just looks at it as an extension of Carl himself. The trust's income is reported right on Carl's United States individual income tax return, Form 1040. But that irrevocable trust, remember, it's out in space. It's an entirely separate tax entity. Because of that, it needs its own employer identification number, an EIN, and it has to file its own separate United States income tax return for estates and trusts, which is Form 1041.
All right, warning, exam trap right here. Trust tax brackets are severely, severely compressed. What does that mean? It means an irrevocable trust hits the absolute highest federal income tax rate at a wildly low level of income. So Adam the advisor has to be super careful here. Often he'll distribute income out to Carl's kids. Why? Well, because it shifts that tax burden over to the kids' much lower personal tax brackets, saving the family an absolute fortune.
Okay, let's test your memory. I want you to pause this explainer right now. Seriously, pause it and think about it. When Carl eventually passes away, does his revocable trust avoid the dreaded, super messy court process known as probate?
Did you guess it? The answer is yes. Both revocable and irrevocable trusts, as long as they are living trusts created during Carl's lifetime, completely bypass the probate process. This is a massive, massive advantage over standard individual accounts that don't have beneficiaries named.
And this brilliantly illustrates our next point, because, well, tragedy has struck. Over in another town, Iris the investor has just tragically passed away after tripping over a rather large, heavy stack of municipal bonds. Rest in peace, Iris. So Adam the advisor must now step in to help manage her estate.
Now, here's the catch. Iris didn't use an inter vivos, or living trust, like Carl did.
Nope, she used a testamentary trust. A testamentary trust is created by a will, meaning it literally only springs into existence after the grantor dies. And because it comes from a will, Iris's assets must endure the entire painful public probate gauntlet before the trust even gets funded.
So, until probate is actually finished, Iris's assets just sit in her estate. An estate is simply the total collection of assets owned by a deceased person. It's managed by an executor if Iris names someone in her will, or a personal representative if the court has to step in and appoint someone. Either way, that person has a very strict fiduciary duty to the estate.
Okay, heads up, here comes another exam trap. An estate account is strictly a temporary holding pen. It literally only exists to pay off debts, pay the taxes, and then hand out whatever cash is left to the heirs. If you see an exam question asking how Adam should invest Iris's estate, the answer is never aggressive long-term growth. Never. The strategy absolutely must focus on capital preservation and liquidity.
Now we have two massive, highly testable numbers you need to memorize. The first is 9. Adam has exactly 9 months after Iris's date of death to file the United States estate tax return, Form 706. You can get a 6-month extension, sure, but that original hard deadline is 9 months.
The second magic number you gotta know is 600. If Iris's estate generates $600 or more in gross income while Adam is sorting out all that paperwork, the estate officially becomes its own tax entity and Adam must file a Form 1041.
All right, let's lock all of this in and build into our high-tempo blitz. It's time for the rapid-fire exam recap. Let's get these top testable points permanently glued to your memory.
Number 1. The 3 amigos. The grantor creates and funds the trust. The trustee manages those assets under a strict fiduciary duty. And the beneficiary? They receive the benefits.
Number 2, the ultimate trade-off. Revocable means you keep control, but you get zero creditor protection. Irrevocable means you surrender control, launch the money into space, but you gain possible asset protection. Next up, revocable trusts, income stays right on the grantor's personal Form 1040. Irrevocable trusts and estates are separate beasts. They file Form 1041. Don't forget this one. Testamentary trusts are born from a will. And because they rely on a will, they must go through the probate process before they are ever funded. Living or inter vivos trusts, they skip probate entirely. Almost done. Estates are just temporary way stations. The investment strategy demands capital preservation and liquidity. Absolutely no aggressive long-term growth stocks allowed. And finally, the estate tax return, Form 706, is due in exactly 9 months. And if that temporary estate account earns $600 in gross income, boom, you're filing a Form 1041. I'm going to leave you with this provocative thought to chew on before your exam. We know the grantor, trustee, and beneficiary roles can legally overlap, right? But if Carl acts as the grantor, the trustee, and beneficiary of his own trust, who is actually policing his fiduciary duty? Think about that. Thanks for joining this explainer, and happy studying.